You say in your book, Crisis Economics, that you think that this crisis wasn't a subprime crisis, but the result of a subprime financial system. This week, we are looking to Washington and financial reform on the Senate side moving forward. Are you satisfied with the Senate bill as it exists today?
No, it's going in the right direction, but it's not doing enough. In my view, if financial institutions are too big to fail, they're just too big, and they should be either broken up or induced to break up. I think that we need to reform the system of compensation to avoid this excessive risk-taking and leverage.
So you don't think that the Volcker rule, in effect, accomplishes what you had hoped reenactment of Glass-Steagall would in separating out proprietary trading?
It goes in the right direction. I'm supportive of the Volcker rule. Bank holding companies that are using insured deposits of the taxpayer should not be involved in prop trading, in private equity and hedge funds. But that's not enough. I would go as far as separating investment banking from commercial banking. And the idea of financial supermarket does at the same time asset management, insurance, prop trading, private equity, hedge fund, commercial, and investment banking under the same umbrella has shown to be pretty much of a failure. So I would go as far as reinstating the kind of restriction we had under Glass-Steagall.
You also want derivatives to be moved to an exchange or to a clearing house. Do you think Senator Blanche Lincoln has it right in her proposal?
I was supportive of that proposal. I think that markets that are dealer markets do not have transparency of prices. There are high fees, high bid-ask spreads, and there are sorts of oligopolistic profits for banks and financial institutions. I would rather have these ones being all on exchanges, where there will be price transparency and more competition rather than the current form of oligopoly.
Won't increased capital standards or capital requirements for banks in some way restrict lending? I mean, that has been the criticism by many Washington watchers, that it'll restrict to not only big businesses, but Meredith Whitney just yesterday raising a red flag, saying that small business is ultimately going to be hurt if we do raise capital requirements.
Well, first of all, these new capital requirements are going to be phased in only over time. Policymakers are worried that phasing them in too fast is going to lead to more of a credit crunch. And we have to think about the system over the medium and long term. If we don't increase these capital standards, then we'll have a problem with new asset bubbles. They're going to imply that banks are going to have weak capital, too much leverage, not enough liquidity, and we'll have another financial crisis. So phase them in slowly over time, but in the medium term, we need them to avoid the next financial crisis.
In looking at the price of gold, it is down a bit today, but it has been steadily on the rise, even in the face of a stronger dollar. Do you believe that there is an asset bubble forming there?
Well, in my view, gold prices go up either when there is high and rising inflation, and for now there is more deflation in the US, in Europe, in Japan, or when there is a risk of another global or regional financial meltdown. So gold was going up after Lehman a year ago, when many banks looked like insolvent. Is going back up again right now because there is nervousness about the Eurozone, about the risk of a breakup of the euro, about the risk of banks and government being insolvent. Therefore, it's a symptom of the risk aversion and nervousness of financial markets.
So what is it that you're looking at as an indicator here of what you say is a financial crisis? I mean, are you looking at LIBOR, which is on the rise, but far from where it was in the heat of the crisis?
I look at many things. First of all, certainly the funding problem in the interbank market with the LIBOR or S spread widen again is a signal of trouble in the financial markets in Europe, the beginning of liquidity crunch. I'm worried about the sovereign insolvency risk as being a rising risk. It's going to affect financial markets. There are signs of risk aversion. There's been greater volatility of market in the VIX. There's some widening of credit spreads for the sovereign. So there are many indications that right now markets are nervous and worried that the next stage of the financial crisis is going to be sovereign debt problems and the inability of weak governments to do the right thing, meaning raise taxes, cut spending, and avoid either default or inflation.
But if the Fed's already opened swap lines, and if we've already seen this, $1 trillion quote-unquote nuclear option in Europe, why aren't you getting some relief that there is some form of government help here, keeping another crisis from unfolding to the extent it did in 2007, 2008?
Well, there are two reasons. One is that there is still a risk that this country are not going to be able to do the fiscal austerity that they need to, or the structural reform that restore competitiveness and growth. And this money is not coming for free. It's only conditional on this country credibly doing this fiscal austerity and the structural reform. There is a chance that politically that's not going to be feasible to be done. So one thing is to announce things, another thing is to do it. And therefore, I think that the markets have improved compared to not having this $1 trillion rescue package.
So you're saying that these European governments in Portugal and Spain and elsewhere aren't going to be able to carry out these austerity measures that they're going to take, say they're going to take?
It's very challenging. They're going to do some of it, but as they do more of it, the recession might become more severe as you raise taxes and cut spending. There'll be more protests in the streets, more strikes, and many of these governments are weak multi-party coalition governments.